I know there's been some YouTubers out there that are talking about the Great Reset. Listen, they've been talking about that for 15 years. And if you were waiting for the Great Reset for 15 years, you missed out on stocks returning hundreds, if not thousands of percentages.
One thing for candidates to have an economic campaign platform, but it's quite another thing to have a recession on your hands if you win the election.
The banking crisis will continue. It'll make it harder for the average person to get a loan, and the Federal Reserve will see this as the economy goes into recession, and eventually they'll start cutting rates, and eventually the more cowbell comes back. And as I like to say, it is written. We kind of know. There's no other outcome.
As we go deeper into recession.
Tom's a great entrepreneur, and I think he should stick to selling protein bars. And there are people out there saying we're in a recession right now. We're not. Troy Charles and myself did a 90-minute live stream last night, covering our team's thoughts on various topics. I'll drop a link in the description below. Please subscribe to it and my Stock Talk YouTube channel. In it, we covered a lot of ground, including yesterday's Federal Reserve meeting and actions, the upcoming presidential election, seasonals in the stock market, covering economic data, inflation, economic growth, and where we stand versus our team's 2024 overall market outlook and our second half of the year. So far, year to date, it's pretty much trading on plan for the year, and we haven't changed our optimistic outlook for year-end 2024 of around 5,800 on the S&P 500 since we first alluded to it in the fourth quarter of last year, 2023. Our early first quarter 2025 target remains 6,000, but given the current backdrop and what I'm seeing, I lean that 6,000 figure is probably too low by up to 200 S&P 500 points under a soft landing Goldilocks year-end, fear of missing out, moving post-election, extending into inauguration time. For today, I'm sticking with a few important charts. Regardless of what you might hear on TV or the internet about this or that chart being key or the most important chart to watch, none is more important than the largest stock market index in the world, the market cap weighted S&P 500. Take a look at the year-to-date daily chart on the S&P 500. For the most part, it's up and to the right with weakness during its normal week post-July 4th holiday into early August. The chat boards and financial networks were in panic mode after the August 1st move down. Why? Because that little candle on August 1st is called a bearish engulfing candlestick formation. So, hey, Chris, what is a bearish engulfing formation? Well, that pattern consists of an up candlestick followed by a big down candlestick that eclipses or engulfs the smaller up candle. This is what it generally looks like. Technicians consider the worst of these formations when the engulfing candle has a big up opening and closes on or near the engulfing low of the day. This is considered a bearish reversing trend, usually occurring at the top of an uptrend. Given the timing of this move down, negatively oriented traders were out en masse calling the top was in. Many, not only for this summer, but also for the bull market. Okay, so back to charts. The second most important chart to me remains the chart of real-time real interest rates. Real rates are the premium a Treasury bond investor receives over the inflation rate for holding a U.S. government Treasury bond. This is really the main lever the Fed has at slowing inflation, but it's also the one that can cause companies and investors to hold back from investing on hiring or capital investment and cause recessions in the U.S. Take a look at the super short-term, one-year, real-time, real interest rates we've discussed all year. Only during the dot-com bubble, the pre-Great Financial Crisis in 2007, 2008, late 2018, and recently has this yield premium exceeded 3.75%. This is why many prominent hedge fund managers have finally said the Fed is too tight and recommended that they cut rates by 50 basis points at yesterday's meeting. An opinion our team has had ever since they skipped cutting rates at the July meeting. The final two charts I want to focus on are ones of volatility. The first chart is on realized volatility, or RVol index on Bloomberg. This is the actual level of volatility that stocks are experiencing in the market or on your screen if you're watching them. As you can see from the chart, the trend had been lower for about 18 months, but it has recently moved from 8 to over 20 and now sits around 14. I remind investors that historically, 1, volatility is quite seasonal, with normal spikes in volatility higher in midsummer and early fall and lower trends in winter and spring. And second, realized volatility is also normally higher in the 2 months preceding presidential elections, the period we just entered. However, when discussing volatility, I feel compelled to discuss implied volatility as well. What's that? That is what is priced into the options market. This is the market participants' best guess of what the future will hold. Take a look at the chart of the 2-month futures contract for forward volatility. This contract expires in mid-October, so it's the one pricing volatility into a normally weak seasonal stock period, as well as into a couple weeks before the election. As one can see, it too has risen during a normal volatility period. However, it's starting to come down off its feverish high. Finally, I must point out that regardless of the way we feel as investors or voters about the election and volatility in the markets, the numbers show that volatility is actually declining into the election and being priced for a gentler escape from November than 6 months ago, when things looked more certain about who was running and who might win. If you don't believe me, take a look at the volatility curve now and 6 months ago. Investors, the blue line in the chart was the forward volatility curve 6 months ago, and the white line is the curve as of September 15th, when we taped this. Looking at the data points that overlap currently are the September expiration, which is UX1, October expiration, and November expiration. In all three cases, the current price of insurance is below where market makers were asking for insurance 6 months ago, and future insurance costs for 2025 are below what it would have cost you to hedge your 2024 election for the better part of a year. So wrapping it up, what does this mean for you and your money? It means the odds are rising that regardless of whether you favor a candidate or not, who wins or loses in the election in the next few weeks, your money in the overall stock market will be treated okay for late 2024 into the inaugural ball in late January 2025. That our 6,000 upside optimistic target for the first quarter of 2025 might actually be a few hundred points too low, not too high. That said, for now, don't get greedy when stocks are up on spikes and volatility is low. And don't panic and sell stocks when volatility spikes and stocks drop. Our investment team does believe that over the next few years, a more active stock management style will begin to reassert itself and be rewarded relative to passive index investing. If over the years you found yourself reacting emotionally in your portfolio to presidential elections and their uncertainty, or when volatility is high like it was in July, and now it's time to step back, take a deep breath, give your advisor a call and talk and walk you through your long-term financial plan. If you're uncomfortable with a wider range of possible equity outcomes, our Oak Harvest team has launched a new strategy that retains the ability to go long stocks, short stocks, as well as buy partial hedges and shock absorbers for your stock portfolio. You can find information on this new strategy of ours at oakharvestfunds.com. For myself, from Eric behind the camera and the whole team supporting us, have a great weekend.